Let's now, so we've had a great discussion about all things markets. Let's tie it back to the lifespan managed portfolios that the investment committee manages and you have an input in along with other investment committee members. How are we, just talk briefly about how we're positioned and have we made any changes over the last 3 months in light of some of the things we've discussed today?
No, I think we've been conservatively and defensively positioned. In fact, we were last quarter and we continued that into the second quarter. I mean, clearly, I need to acknowledge to everyone watching and listening that my view on the US equity market, and you remember this, Eugene, and I think it was even before I became a member of your investment committee, but at the end of 2021, I know that's an eternity ago, I was very, very negative on the US market and looked for a 20 to 25% decline. We got that. I then basically came out, I don't know what I was trying to be, a hero or something. I should never try and be a hero, Eugene. It's dangerous. And I then called for that 3,000 S&P 500 target. And that number has been a bullseye on my back ever since. And I can't tell you how many arrows I have in my back. Just to remind everyone, because this is, I think, preceding when I joined your committee, the 3,000 S&P 500 target, which I had for 2023, which is obviously the current year, was predicated or built upon a price earnings multiple of 15 multiplied by earnings per share of $200 for calendar 2023. I know that's a mouthful. So 15 times 200 equals 3,000. And I've kept to that target. And I just say that we're in August, so there's still 4 months to go. What is the likelihood of that target being met? It's probably very, very unlikely, although stranger things have happened in life. Anyway, the bottom line is I've maintained a conservative and defensive view of markets because, of course, we're being rewarded for the first time having some exposure to fixed rate assets and particularly high quality assets. So the recommendation and the opinion has been basically favoring a longer duration, high quality government bonds, particularly here in Australia versus the United States. And I think if you actually have to make a choice between Australia and the United States, you tend to favor Australia because we don't have the budget deficit kind of issues that we have in the United States, which has really been brought to our attention or re-impressed upon us by the downgrade by the Fitch credit rating agency of US sovereign debt. So at the end of the day, I think a conservative defensively positioned portfolio is still appropriate given some of the conversations we've had already. Namely, we're going to see these central banks keep rates higher for longer. We've got negative headwinds coming out of China. We haven't had time, and we won't probably have time today to talk about the Eurozone, but don't forget, the locomotive of the Eurozone, Germany, is in recession. I mean, we kind of conveniently forget that every now and then. And sadly, the UK is heading in that direction as well because of interest rate impacts, particularly through the mortgage market. So at the end of the day, I think a conservative defensive position and a very well diversified portfolio is appropriate in this kind of environment. I think price earnings multiples, particularly in the United States, are at the higher end of their historical averages. And so therefore, I think a more defensive kind of positioning is appropriate. One of the things about financial markets, which after, I don't know, when did I start in this market? 1984, is investors have this really curious habit of basically selling when markets are really cheap and buying when they're really expensive. And we do the opposite. So if you walk down a high street and there was a sign saying, okay, everything's half price, and no one went into the store because, of course, it was just too cheap, then the next week there was a big sign saying, we have doubled our prices, everything's unbelievably expensive, come in and buy, and everyone flooded into the store to take advantage of those much higher prices. You and I would both say, well, that's just ridiculous, but that's what we do in the markets. Historically, that's what we do. And we know in the US right now, everyone is all in. And I could go on forever about this, but the CTAs are all in. The fund managers are all in. Everyone is all in. All of the sentiment surveys are telling me that. The option crowd, all of them are all in. Call buying massively outnumbering put buying. All of the sentiment ratios in the US are telling me watch out here. And we haven't talked about commercial real estate and the other things in the United States. But at the end of the day, I still think a conservative defensive portfolio is really appropriate in this kind of environment. Looking at the fundamentals, if you're driven by sentiment, yes, of course, you're going to be all in. And that's what I think has basically driven people into the market in the last few months.
Okay, thank you for that, Jonathan. So I guess to summarize, we haven't made any real changes in the last quarter, largely because we're already positioned in the way you described, underweight equities globally, underweight listed property, overweight longer duration bonds, high quality bonds, emphasis on quality. It's definitely not the environment in our view where you want to have low quality bonds at this point in the cycle. And potentially the only change we're looking at in the short term is to add to that bond portfolio and possibly also, to moderate how underweight we are in our tactical strategy. We may move from being extremely underweight to just very underweight, but still remaining incredibly cautious and diversified is also very important. Is important because if there is a shock due to some of these things, often the shock can be concentrated in one sector, one country, one type of market. So that's where diversification becomes really important to minimize any fallout from that.